So inflation is a concern now, obviously, with what we're seeing around the world, obviously, and with the Fed, and they're going to be talking about it today. You make the point that full employment, Phillips curve mentality doesn't necessarily cause inflation because with productivity, you can avoid that. And I think you're concerned, though, that we may not get it this time with some of the Fed's actions and staying low for too long.
That's right. That's a good summation of my concerns. The reason people fear inflation now is they very rationally see that there's been a tremendous amount of liquidity injected into the system. And we've all learned that too much money chasing too few goods can cause inflation. The problem in thinking that it is a Phillips curve trade-off is believing that if we get a hint of inflation, then we have the tools to fight that. Well, the tools to fight that are to raise the interest rate paid on reserves or to keep buying even more, to interact more in credit markets. And so I don't think the Fed is going to start selling back anytime soon. And I'm concerned if they hint that they can raise the rate paid on excess reserves, which are already at a record high at 3.6 trillion, that they are furthering this tendency of banks to be more interested in interacting with the Federal Reserve than private lending. And the way you get productive economic growth, the kind that actually increases the output of goods and services, is to encourage small business. That's where the jobs are. So I'm concerned the Fed is in a little bit of an untenable position in that they think by expressing a new tolerance for inflation, they're somehow helping the lower wage workers when in fact they're the ones hurt the most by inflation. And I think they're discouraging private lending, which would be to have the banks quit piling up reserves at the Fed and to lend them into the real economy. Then you would get real growth, the kind that raises wages without causing inflation.
You point out that you think the Fed may have gotten the wrong idea about keeping rates. They waited too long after the financial crisis. Then they raised rates too quickly, I guess, at that point. And you were seeing full employment going at 3% or whatever. We've never seen numbers like that. Unemployment at 3%. And they got the idea that staying low caused more people to come back into the workforce, when in fact you say it was deregulation and corporate tax cuts and other structural changes in the early years of the Trump administration that got us down to those levels. It wasn't the low interest rate. So it's not going to work this time by just staying low in terms of interest rates because you don't have the same dynamic. Have I got that part right?
I think perfectly. If you think about what happened after 2008, we stayed at zero for 7 years and then a very tentative 0.25% gain at the end of 2015, another 0.25% gain in 2016. And then under Chair Yellen, we went up 3 times in 2017, and then under Chair Powell 4 times in 2018. That's 9 consecutive increases in the interest rate. And what I think they took from that is, we better stop now. They ended up pulling back 3 of those increases in 2019. But what it was really about, those excellent growth years when we were seeing more low-income people, minorities, more people employed. So we had the record low unemployment. We didn't see inflation. We were getting productivity gains in excess of the wage gains. That's exactly where you want to be. I think that they didn't acknowledge that the real boon to business and employment were the structural changes. And it was under the pro-growth economic agenda of the Trump administration that they cut taxes and they reduced regulations. That is how you create jobs, and that's especially good for small business. I hate to think that now we're even talking about removing those incentives because you really want to prioritize the private sector. You don't want to make banks into utilities working with the government. You don't want to have the Fed running the economy. If you want productive growth and you want to foster high-wage jobs for the real economy, for people who don't just follow Fed moves minute to minute, but who actually go out and produce goods and services, I think you have to have a smaller footprint for the Federal Reserve and to be very cognizant of how, in a subtle way, some of your tools are really orienting financial markets to be watching what the Fed and the government are doing versus investing in potentially very prosperous opportunities.
Judy, I have to admit I'm confused, though, because despite what you're saying, back in the summer of 2019, when your name was drawn up to be a nominee, you were arguing publicly for lower interest rates.
Well, it's interesting, Andrew. What I was saying at that time is you have productivity gains in excess of wage gains. You have record low unemployment, and you don't see inflation. We're seeing the benefits of those structural changes that I mentioned, the tax cuts and the deregulation. Let that ride a little bit. And I was criticized for taking that view, and within 2 months, everyone at the Fed was taking that view, and they ended up taking back those last 3 interest rates. My point is that there isn't a trade-off. It's not a choice of inflation or high employment if it's productive growth. If it's just empty liquidity chasing after assets, financial assets, and not really invested, it's more speculative than true investment, true financial intermediation aimed at a more prosperous future, then you have to be much more careful. But when things are going well, then I don't think you preempt it, or you are back to that Phillips curve thinking.
Shepard Smith here. Thanks for watching CNBC on YouTube.